day to our lecturer Muhammad Faisal bin Basri and my fellow classmate. Today we will be presenting our financial benchmarking analysis for 4 notable companies within Malaysia in the technology sector. The primary objective of this assignment is to conduct a detailed financial benchmarking. We will use the 4 key pillars. First, liquidity to see how well they meet the short-term obligation. Leverage to analyze the debt level. Efficiency to see how well they use the asset. Profitability to determine their overall earning potential. This will help us to determine which the strongest competitive position in the market. Our study, it is important to understand that E&E sector is the backbone of Malaysia economy. Between 2023 and 2025, this industry had a massive growth fueled by the global digital transformation and insatiable demand for AI-ready semiconductor chips. The performance of technology sector, we have selected 4 distinct companies. First, we have UNICEF and Inari. These are the heavyweight in the semiconductor space, especially focused on the testing and packaging of chip semiconductor, which is critical part of the global supply chains. The second one, we have Virtox, which is a market leader in advanced optical inspection system. And then finally, we have MGO Holding. Unlike other, this one focus on digital software and application development, which provide a different perspective on how technology value created beyond hardware. By comparing these 4, we aim to see how these different business models have performed financially over the past few years. Now, I will pass my slide to our member Ashikin to begin deep into the liquidity and leverage trend.
Next, I will present the liquidity analysis based on the current ratio and good ratio from 2023 to 2025. Liquidity ratios measure a company's ability to meet its short-term obligation. Based on the result, Agmo recorded the strongest liquidity position with a current ratio of 10.81 times and a quick ratio of 10.59 times in 2025. This indicates that Agmo has more than sufficient liquid assets to cover its short-term liabilities. Inari also demonstrated strong liquidity and showed an improving trend throughout the 3 years. Virtox maintained a healthy liquidity position, although both its current ratio and quick ratio declined over time. Unisem showed the weakest liquidity performance with its current ratio falling below 1.0 in 2025, indicating potential difficulty in meeting its short-term obligation. Moving on to leverage analysis using the debt ratio and times interest earned ratio, Agmo recorded the lowest debt ratio at 9.12%, indicating low financial risk. It also had the highest time interest earned ratio, showing a very strong ability to pay interest expenses. Inari also maintained a low debt level throughout the 3 years. Virtox debt ratio increased to 27% in 2025, but its interest coverage remains strong at 40.01 times. Unisem recorded the highest debt ratio at 32.45%, making it the most leveraged company among the 4. Overall, Agmo and Inari show the strongest leverage positions, while the Unisem carries the highest financial risk.
Assalamualaikum, my name is Christina Shuhada. So I will present about activity analysis. So in average collection period, Unisem is the industry leader in credit collection efficiency, taking just 44 days to 10 credit sales in the cash. Inari follows at the moderate 84 days. However, Virtox is 160 days and Agmo 159 days, reveal a major operational bottleneck. Taking over 5 months to collect cash from customers suggests weak credit control or excessive bargaining power held by their clients, which can severely tie up a working capital. So next is fixed asset turnover. So in fixed asset turnover, ACMO also records an extraordinary turnover ratio of 25.6x. This reflects the immense efficiency of its software-based asset-light model, which generates high revenue without needing expensive physical setup. So for Vitrox shows a healthy progress at 3.43 as its automated inspection system gain market traction. So conversely, Unisem for 0.80s and Inari in 0.40s have low turnovers, which is standard for capital-intensive outsourced semiconductor assembly and test. So this will provide their require is so heavy ongoing investment in manufacturing plants and machinery. So next is about a profitability analysis for this company, how well companies generates returns. So for operating profit margin, ACMO leads the pack with a dominant 28.89% operating margin, proving it has immense pricing power and excellent control over its operational costs. So next is for Vitrox 21% and Inari 16.72% show reasonable core profitability through Inari face a clear margin contraction from intense industry-wide competition and rising production costs. So for Unisem, they struggles at the bottom with a slim 5.10% margin, meaning a large chunk of its revenue is completely consumed by a high overhead costs and intense factory running expenses. Next, for return on equity for this company, so for ACMO provides shareholders the highest return at 14.49%, while its ROE slightly dipped. This is so healthy structural trend caused by a growing equity base from accumulated retained earnings rather than a drop in actual net profit. So for Vitrox demonstrates stable performance at 11.67% and Inaris plummets sharply to 7.75% due to a steep drop in net profit, while Unisem underperforms below 5%, offering weak returns relative to the massive equity investment made by its owner. So lastly, for this conclusion, which is most efficient? So the most efficient is ACMO because they have squeezing revenue out of its physical fixed asset, but Unisem is far superior at short-term working capital efficiency due to its fast credit collection cycle. So for which company is more profitable? Also ACMO Holdings perhaps is the clear winner across the board. It maximizes both operational cost efficiency and final bottom line returns for shareholders. So for the key trend to highlight, the tech sector is facing a sharp structural divide. High margin software driven companies enjoy a lucrative profitability but must tighten their weak credit collection periods. On the other side, hardware and semiconductor heavyweight are dealing with heavy capital expenditure pressure, as seen by Unisem, whose short-term liquidity dropped to a risky 0.90x current ratio due to funding its massive new Gopen factory expansion.
Hi, good morning. My name is Nur Ain Shazwina binti Muhammad Kamil. My student ID is 2025439902. Let's jump straight into the market performance of our four companies between 2023 until 2025, focusing on how much value they are actually create for their shareholder. First, looking at the earning per share (EPS), the trend tell very different story. Inari historically delivered the higher EPS, peaking at 24.0 cent in 2024, but it suffered a sharp decline down to 11.0 cent in 2025. Vitrox shows a fluctuating pattern but recovered nicely to 7.04 cents by 2025, while Unisem held completely stable at 5.0 cents. How about ACMO, on another hand, shows a very promising growth trend, rising constantly every year to reach 2.52 cents. Now we pivot to the dividend yield. The contrast is even more obvious. ACMO paid 0% dividend across all 3 years. This indicates a growth strategy where they choose to reinvest all their earnings back into the company rather than paying out cash. Unisem and Inari provide stable moderate return for income-seeking investor, hovering between 1.67% and 2.65%. Victrox is massive standout here with an unstable high trend, offering huge yield like 59% in 2023 and 45% in 2025, making them highly attractive but volatile. Moving on to our overall benchmarking metrics. Let's summarize how these companies compare when we look at the metrics side by side. Angmo dominates the board with excellent liquidity, very low leverage and strong improving profitability. Their only real bottleneck is their weak activity ratio, means they take longer to collect cash from customers. For Inari, maintain a strong and low risk profile structurally, but their declining profitability and recently EPS drop keep them in the moderate tier. Victrox shows balanced, adequate financial health with good profitability, heavily carried by the incredible high market dividend yield we just looked at. Unisem finished at the bottom of the metric, showing weak liquidity, high and worse leverage, and poor profitability, even they are highly efficient at collecting customer payment. To wrap up our presentation, let's look at our final leaderboard ranking and critical takeaway. Our financial over-ranking place is Angmo, is our top performers due to flawless cash flow and high profit margin. Inari as a solid performer that remained fundamentally resilient. Victrox as a healthy performer with great investor return. Unisem as the weakness performer, slightly a clear need to urgent financial adjustment. However, to keep this analysis objective, we must highlight two major limitations. First, the entire analysis relies purely on heuristical data. It tells us where the companies have been, but past success doesn't guarantee future market movement. Second, it is exclude non-financial factors. Things like overall industry growth, macroeconomic shift, corporate management change, or major factory expansion are not captured in these numbers, meaning this data only tell us a part of the story. Thank you.